Today's video is going to be about seller financing. We're going to run through an example of how it works, and you should watch this video if you are looking to buy real estate in today's high interest rate market and you're interested in figuring out how to close gaps. Let's say you're at one price, the seller's at another price. You need to figure out a way to close the gap. This is a really good way to do it, and this happens all the time in commercial real estate, and we're going to talk about why and how structuring seller financing can dramatically change how much money you're putting out of pocket and your returns. So I'm going to share my screen here. So we're going to go through this example and then talk about and then break it down why a seller would do this, why a buyer would do this, and the benefits, the pros and cons. So I basically took this sheet of paper and I just took a picture of it, and we're going to go off. I deliberately didn't use a spreadsheet because I wanted to keep it simple, because you can do back of the napkin math here to figure this out without getting too complicated. So before I go into all the numbers, we're going to assume that we're just buying $1 million property, and the net operating income, let's say it's $1 million apartment building, 12, 13 apartments, however many it's going to be, and the net operating income every year is $95,000. So it would be about a 9.5 cap. Not impossible to find in today's market. We can talk about how the numbers change if it were, say, an 8 or 8.5 cap too. So I'm going to run through this real quick. You can pause the video afterwards if you need to go back through anything. We're going to talk about the straight up scenario and then the seller finance scenario on the right. So let's say you're buying this property for $1 million. You're going to put 25% down, and you're going to get a loan for 75%. So it would be about $250,000 down. You add in the closing costs. Let's say it's $40,000, and you're out of pocket about $290,000 to buy the property. You were going to go get a loan from a bank, let's say a regional bank. You can get this type of loan at these terms in today's market. Let's say it's 7%, amortized for 25 years. Your annual debt service is going to be about $63,600 a year. So now we're going to talk about the cash on cash, because we have all the numbers to do that now. So first, you're going to figure out your cash flow every year. So you take your NOI, $95,000 minus the $63,600. You're at $31,400 a year cash flow. To figure out your cash on cash, you need the amount of money out of pocket that you put down to purchase the property. So $31,400 out of the $290,000, and you end up with about a 10% cash on cash return. Now, mind you, this is year one cash on cash return. If you're planning on doing some value add or improvements, that might change your year 2, 3, 4, 5 numbers. This might go up, right? So let's look at it now. If you were going to ask the seller to finance just 10% of the purchase price, which would be $100,000, and let's say you were going to structure the deal with seller credit, which is another huge way to reduce your money out of pocket. Very common too. So instead of $1 million, you notice this purchase price is going to change to $1,040,000. Okay, now you're just going to have the seller pay you back that $40,000 at closing. Great way to reduce your out of pocket, the funds you need out of pocket. So these are numbers. This goes up a little bit. 25% down to the $1,040,000 is $260,000 instead of $250,000. Your closing costs went up $1,600. So your total cash needed is now $301,600. Now here's the fun part. You take out your seller credit, $40,000. Take out your seller finance, because remember, if the seller is holding a mortgage, you actually get that money back at closing, which is really cool. So you're not going to need $301,000 anymore. You're only going to need $161,000 for your net out of pocket. All right. So what does your loan look like? How do these numbers change, and how does your cash on cash change? Your loan goes up a very small amount, $750 to $760. Same terms. Your annual payments are now $66,144 instead of $63,600 over here. Now you have to make sure you're going to have a second mortgage in the property, so you have to add this into your annual debt service. $100,000, we're going to assume 5% interest only, which would be $5,000 a year. Let's talk about it right now. This number is a big part of the whole transaction, right? The seller may not agree to 5% interest only. They may want 6, 7, 8%. You might negotiate only principal payments, but the amount may stay the same, right? So this number could change. It's all depending on what you negotiate. Some sellers want interest. Some sellers are okay with not accepting interest if the purchase price is higher. So it varies, okay? So how does your cash on cash change? Again, $95,000 a year is what the property brings in. Now your payments are higher. They're at $71,144. So you're netting $23,856, okay, because you're paying on two loans. But since you put so much less out of pocket, your cash on cash is 14.7% instead of 10.8%. All right, so I'm going to pull this back out so you can see the difference and talk about a few reasons or why a seller would do this and why a buyer would do this. So I'm going to switch back to the main screen. Okay, we're good to go here. So a few notes on seller financing. By the way, these kind of scenarios it's really all I think about all the time. Once you look at so many of these and you can estimate payments and returns. And I always try and look through the lens of trying to structure something this way before and let the seller tell me no, and then go for just a straight cash offer if we need to, or cash. It doesn't have to be cash, but the seller getting all their cash up front. So two things. Why would a seller do this? Number one is to save on their taxes. So you might be able to you may be able to structure a deal. Let's say a seller owns a property outright. If they own this property outright, let's say you might be able to offer them $200,000, $300,000, $400,000 down and get them to seller finance a much larger portion of the property. And many sellers will do that because if you have $1 million capital gain, you might be paying 35% tax on it. And many sellers don't want to do that. They'd rather pay the capital gain on just $200,000, let's say. They'll take payments over a certain amount of years, and then they'll take the rest maybe in a lump sum 10 or 15 years from now. So that's one reason. The second reason is if you structure it where you're paying them interest on their money, they're actually earning interest. So if they got the cash back, they would have to find somewhere else to invest it anyway, right? So it's really a benefit for them. And the third thing, which is very important, that people don't really factor in, is if they agree to this, they have a mortgage against your property, and they can take the property back if you don't pay the loan. So what I think people sometimes forget is a private mortgage holder that's behind a larger loan from, say, a bank, can foreclose on the property quicker than a bank can. So let's say you run into trouble, your project doesn't go as planned, and you stop making both payments to the bank and the seller, or just the seller. They can take that property from you, and that's basically it covers their risk of taking a bet on you and you you running through your business plan and improving the property. So it's a big number 3. Okay, and again, you would want to do this as a buyer to reduce your amount of money out of pocket. All right. Now, let's say the property does not make a much higher the return than what the interest rates are in the market. So right now, interest rates are about 7%. Let's say the property is only a 7 cap or an 8 cap. The numbers that you have to change is the amount of money you put down. Okay. So the concept is still the same, but instead of, let's say in this second example, you ended up putting $160 down out of pocket, you might still need to be at $260 or $300 or $350 or whatever it is out of pocket, but you can still bridge the gap by having the seller. In that case, you may want to have the seller hold more money or hold the same amount of money and only take principal payments and make them smaller payments. You can always work the numbers once you know what your maximum payments, you can just finagle the numbers based on what the bank is going to lend you, basically. So that's a whole nother video talking about detail about this, but you can structure any scenario with this. It just depends on how much the seller is going to hold back versus how much you're borrowing from the bank, and you can always close the gap a little bit by inserting this into a transaction. So that's all I have to say for now. There's a lot more that I can talk about. I'm going to start making videos like this a few times a week. Wanted to keep this under 10 minutes, which I think we're right at. And I appreciate you watching. If you're still watching right now, throw me a like if you can. And I appreciate you watching the video. And I'll see you in 2 days. later.